10 seconds here, but I guess the first quarter really had some specific sort of one-offs, right? Because you had a situation where you had port closings. 2.3% is the number, Mark Zandi, up 2.3% for the second quarter after that contraction in the first quarter. Am I right to say that there were one-offs, or is this just a very slow-moving story?
Yeah, one-offs, really, really bad weather, the port strike, and, of course, the downdraft in the energy sector because of the collapse in oil prices, which probably continued in Q2, maybe one of the reasons why the GDP number for Q2 is on the soft side. Maria, do you know what the revision was to Q1? Did they revise that up? I think that was the expectation.
The first quarter was revised up. We're just getting these numbers right now, Mark. Up 0.6%. Yeah. So 0.6% revised in the first quarter, and the second quarter coming in up 2.3%, Mark.
Okay, so that upward revision to Q1 was a little bit more than anticipated, so that probably came out of Q2. So a lot of the revision is related to seasonal adjustments. So they fixed their seasonal adjustments, which raised Q1 growth. I'm sure that's part of it, and took a little bit of the growth away from Q2. So on net, it's probably pretty close to expectations. And bottom line, of course, I haven't seen the details of the data, but my sense is that this wouldn't change my view. The economy is still probably growing about 3%.
Mark, is that it for us? Do we just grow at 3%, 2.5%, 3%, or is there something that can happen here to get the economy restaging growth?
I think the 3% is about what we're going to get over the next 18 to 24 months. I mean, the one thing that could push us to a higher pace of growth is if housing, single-family housing, kicks into a higher gear. That's going to happen. The level of construction in single-family housing is way too low, and we can feel the housing market tighten up. So we're going to get a lot more construction. And if that ramps up more than anticipated, then we can get that plus 3% growth. But I think my sense is the economy, 3%-ish is about what we should expect over the next 18 to 24 months.
And we should point out that it was consumer spending that's driving this in the quarter, Mark. So we've been waiting to see consumer spending sort of pick up. We're certainly seeing a bit of it in this quarter, the second quarter. Kim, the backdrop for investing, you've got to allocate capital. Is this the right environment to do so? Where are you on U.S. stocks and allocating capital right here?
Absolutely. We are still buyers selectively of U.S. stocks. We think the U.S. clearly has the strongest growth path at this point worldwide. But we're still looking at those jobs numbers, and because as this report shows, people are out there spending money. The consumer is spending money. Where do they get their money? From jobs. So I think that's key, and I think the Fed is looking to that as an excuse to raise rates because they're looking for wage inflation as well. So that could be the thing that gets this economy going is jobs and more money to spend.
Mark, it's Dagen. Mark, what's the single biggest risk to growth? What do you worry about?
Trade. I mean, I'm sure the numbers show trade was a huge drag in Q1, probably a continued drag in Q2, and at the heart of it is the very strong dollar, which has appreciated almost 15% over the past year. That's a really large increase in a very short period of time, and it's causing a lot of agita in parts of the economy. And, of course, slower global growth, and a lot of that's centered around what's going on in China. So if I had to pick one thing I'm most worried about that could undermine my optimism, it would be if the Chinese growth slowdown is less graceful than I'm anticipating.
Well, Mark, this is Sandra Smith. I think everybody's probably looking at this number. First, they're looking at the futures markets that really haven't budged much on this number. If anything, they weakened a little bit on the miss or the disappointment in the number. But everyone's probably trying to interpret what this means for the Fed's next move. Are you getting any indications from this report on how that's going to play into the Fed's next big decision?
I think the key for the Fed is jobs. So we have two jobs reports between now and the September meeting. And if we get monthly job growth that's consistent with what we've been getting, 200 to 250,000 per month, I think that would be sufficient for the Fed to raise rates in September. We also have a report tomorrow on wages, the employment cost index, which is the best measure of wage growth. If that comes in 0.6, 0.7, roughly what we got in Q1, I think that also would be consistent with a September rate hike. So I actually think the bar for a rate hike came down a little bit with yesterday's FOMC statement. They're just looking for the job market to continue to post gains like we have been getting. And you know, my forecast is that they'll get it.
Maybe, but you know, you had consumer spending up 2.9%, but you had business investment down. So we're waiting for this capex boom, which has not materialized yet. Business investment down again this quarter. What's holding back businesses from spending, Mark?
Well, the key there, Maria, is energy. The energy sector is just cutting, slashing. You know, we've lost 70,000 jobs in the energy sector since the beginning of the year, and they're cutting. Yes, they're significantly cutting back. I think abstracting from that, the investment spending is not gangbusters. It's not boom-like, but it's been pretty good. I mean, if you look since the beginning of the recovery 6 years ago, real fixed investment, that's business investment, has grown 5.5% per annum, which again isn't gangbusters, but that's not bad in the grand scheme of things. And research and development investment is booming. It's a double digit, and it's as high as it's been as a share of the GDP since the data has been collected since World War II. So yes, investment spending has been a bit disappointing, and right now it's very disappointing because of what's going on in the energy sector. But you know, broadly speaking, it's not been too bad.
The dollar is strengthening right now on this GDP number. The likelihood that there might be a rate rise in September, strong dollar, rate rise in September, does that hurt GDP going into 2016 and the presidential election?
Well, I mean, right now the markets are roughly anticipating either it's a September hike or a December hike and then some rate increases next year. So if we get something close to that, then I don't expect any further increases in the value of the dollar. Presumably, the dollar reflects that expectation. Now, if we have a much even stronger economy, more job growth, stronger wage growth, inflationary pressures start developing, the Fed has to tighten more aggressively than what markets currently think, then yeah, that would probably result in a stronger dollar, take some steam out of the economy down the road. But, you know, I think that's a problem that wouldn't be too bad if, in fact, it's being driven by, you know, much stronger job growth over the next 6-12 months.
Hey, Kim, it's Dagen Mcdowell. It's good to talk to you again.
Hi.
What about the rest of the world? You like U.S. stocks. What are you avoiding?
Well, we've been avoiding China just because it's, we'll just say, opaque. But we certainly do want American companies that have exposure to China, and we play that by having considerable exposure to aerospace, believe it or not. The Chinese need to buy planes to fly to other places of the world. Their economy is still growing at this point, and so we've been playing it through kind of the back door into China. But that's kind of how we play the rest of the world. We always look for companies that have exposure around the world, because you really can't. I mean, we have a good idea of where growth is, but growth can occur at any time. And that's the great thing about being an investor, is you get an upward surprise every once in a while.
Sure do. Kim, good to have you on the program. Mark Zandi, thank you so much. Kim Forrest, Mark Zandi joining us today. I just want to point